Done this event. Pretty amazing. One year was, of course, on Zoom. And so we've got, one of the most prominent private equity guys in LA here, Jeremy Holland. We're thrilled to have him again. Thank you. Matt has been with us a couple times, and we have some newbies here, Alicia and Tim. So it should be a great event. Where's that thing? Okay. So I'm just going to be up here for just a few minutes, kind of set the stage. This is our firm. We do M&A and capital raising. We're FINRA licensed. Most of our clients have revenues of 10 to 100 million in revenue, or 2 to 12 of EBITDA. Last year for us was a record year. We did over $200 million in deals. Average deal size was over 40. 3 of the deals were industrial transactions. 1 was tech, and 1 was business services. 2 were sold to European buyers, which was interesting, and 2 were sold to very large publicly traded companies. My team is here tonight. Hopefully everybody got to meet Andrew and Sunil. And so in terms of the trends, a lot of this data came from PitchBook, so thank you to PitchBook. Last year, North American M&A was up 16% in terms of deal value, 10% in terms of deal count. What's really interesting is if you look at the quarterly data for 2024, the third quarter was the peak. And the fourth quarter was 23% below the third quarter. And I have to think the election had something to do with that. In terms of the industries that were stronger than others last year, in North American M&A, technology was up 27%. This is in terms of deal value. Industrials and chemicals, which is an area of real focus for our firm, is up 63%. Telecom was up over 100%. Healthcare, unfortunately, was down 15%. So just one more point on industrials and chemicals. In the second half of the year, private equity went bananas in that industry, invested $22 billion in the second half, up 2.5 times the first half of last year. So what really drove the activity last year? Inflation came down, obviously. GDP growth remained pretty solid. The Fed lowered rates by 100 bips. Sellers finally began to adjust their expectations. Believe it or not, COVID was 5 years ago, or it started 5 years ago. That's, it still feels like it was like 2 years ago or last year. There's still a tons of cash on the sidelines. Corporates still, dominate a majority of the transactions, slightly more than half. And, a good thing for all of us here, there's still millions of baby boomers that need to figure out what to do with their businesses. Switching over to private equity, last year was the first up year since 2021. And when you look at this chart, it really shows you how much of an anomaly 2021 was. And when I talk to sellers, I also tell them that the valuations in that year was an anomaly. And that's kind of a once in a 10 to 15 year phenomenon. Believe it or not, I've been through a few of those cycles, getting kind of older. The value of US private equity transactions was up 19%, and the number of deals was up 13%. The private equity is kind of fighting back, though, against corporates. Last year, they ticked up to 42% of all the deals, according to PitchBook, so that's good. Exits. I think you're going to hear about, today we're going to hear about the panel, whether they're going to be net buyers or sellers in 2025. So I'm not going to give you the answer, but last year, exits increased 17% from the year before in terms of the number of deals. Add-ons still dominate the landscape. Platforms are always tougher to do, especially if rates are higher and credit is tighter. So again, that's good for most of us in this room that work on deals under 100 million that are typically add-ons as opposed to platforms. If you look at deal multiples, I'm going to show you sort of two size ranges. So this is also from PitchBook. In the $100 to $250 million enterprise value range, the multiples tick down a little bit. Kind of coincides with what I said before about expectations coming down. So the average last year was 10.3, down from almost 15 in 01. But if you look at the deals that we tend to work on, the average is 7 times, and it was kind of flat from the year before. And then this is a chart from GF Data, which ACG owns now. I always like to show this to sellers, who think that since their buddy sold a business for 12 times, that they should get 12 times, but lo and behold, their business is like 10% the size of their friend's business. So this is a chart that really shows you larger companies trade for higher multiples. They're less risky investments than smaller companies. And it's a pretty wide gap. So this is from overall from 10 to 250. The larger ones obviously at the higher end. The leveraged loan market was accommodating last year. This chart looks like it was off, a big spike last year, but if you remove the yellow bar, which was repricings and maturity extensions, it was kind of just an average year. So that's the takeaway from this chart. So what's the outlook? Again, everyone's got different opinions, so here's my opinion. It may be different than, we'll hear their opinions here in a few minutes. I don't see a recession coming, not anytime soon. I know the consumer confidence numbers yesterday or today were pretty awful, but I don't see one. The bid-ask spreads are starting to narrow. There's still tons of capital. The sponsors, I venture to say, are desperate for realizations. There's still a lot of baby boomers. The regulatory environment is supposed to be more favorable. We'll see. I think buyers have adapted to higher rates, especially the sponsors. And frankly, the US is still the best place to be in terms of capital allocation. And we see that when, multi-billion-dollar European companies are buying businesses with, worth 40 or 50 million. You do hear about animal spirits, and I think there is something to this because, people need to be confident before they invest. But there was a survey by Citizens Bank that said 54% of buyers believe M&A will be strong in 25, for the next 5 years. But I'm a little bit skeptical, honestly, about the outlook. Inflation may not stay low. We've got this threat of tariffs. Hopefully they'll remain threats. And then you got the strong dollar. And, all of these factors, most people don't realize, they impact 20, 30, $40 million companies just as much as they impact multi-billion-dollar companies. And to some extent, it's a bigger impact on the smaller businesses. So, is it going to be a good year? Well, January was not such a good month, January 2025. The number of middle market deals was down 27% from January 24, and the value of deals was down 21%. So at least January is showing some caution. What sectors do we think? This will be the last slide. We think services companies, especially domestic services companies, are going to get a premium this year in the market. Tech and SaaS and software companies that have figured out how to fend off AI or become, prevalent with AI will be good. Distribution companies that don't have too much exposure to China or Mexico. Domestic manufacturers and healthcare. So that's sort of our prediction for 2025. And now I'd love to introduce Alida Damoui, an M&A attorney from Stradling, is going to get us kicked off. Thank you.